Okay, good morning, everybody. Welcome to Zurich's annual investment conference. Thank you all for coming, both those of you who have joined us here in the room in the Shelbourne Hotel, and it's great to see a full room here this morning, and the hundreds of you who have also joined us virtually online. This format of the investment conference was a great success last year, running it here in the room and virtually as well, and thanks to our AV team for making sure that everything runs smoothly during the course of the morning. So we've been running these investment conferences for the last number of years, and really we see them as a great opportunity for you to hear directly from our team of investment managers and experts so that they can tell you about how they're managing customer assets on your behalf and also give you some of their views on the markets at the moment. We do believe that Zurich offers something unique in the Irish market. We are an active fund manager, both from an asset allocation perspective and from a stock selection perspective. And we take that approach because we believe it delivers the best returns for your customers over the long term. And I think our record proves that. We do that all with our own team in BlackRock, managing over 20 billion of assets across our equity, cash, bond, and credit portfolios. And as well as that, as part of one of the largest insurance groups in the world, we have access to a Zurich Group team of experts and investment managers. And I'm pleased to say that we'll be joined virtually this morning later on by Guy Miller, who is the Chief Economist of Zurich Group. Just briefly, I'll take a look back at 2023. I know it's a few months ago now, and it might seem like a long way away, but I think it will tell us a little bit about some of the trends that we might see carrying forward into this year, and we have already seen them carrying forward. So I suppose some highlights from the life and pensions market last year. It was a really strong year for business, as I'm sure you know yourselves. The overall market was up 13%, and that was driven largely by really strong growth in pension business, PRSA business in particular, and you can see the numbers there. Pension regular premium business up nearly 20%, and pension single premium business up by a very high percentage as well, 17%. And of course, the other great news is that brokers, and these are half-year figures, but brokers again had a really strong year during the course of last year, a market share of 77%. And that's really building up all the time, year by year. And I think it really shows you in Ireland now, for someone you want to place your business with and whose advice you can trust, it really is only brokers who are providing that service to customers. From our own perspective, we're delighted with how our business is going, both last year and into this year. We're delighted to be the clear leader in the broker market. We're number one in the PRSA market, and we're number one across many other product categories as well. And that's thanks to the support that you give us. And I'd like to thank you today for trusting us to manage your customers' money on your behalf. I'd also like just to thank you briefly for the Brokers Ireland Awards that you voted for us last year as well, particularly the Investment Excellence Award. I suppose looking into this year, and it's already May, so we're well into this year at this stage, but the trends of last year really are continuing, and continuing very strongly. So the strong growth I've talked about in PRSA business last year, we're seeing that again this year. And even though we saw huge growth last year, we're building up on that again this year. We're seeing more strong growth again this year. And I think that just shows, as financial brokers, you're bringing those new funding opportunities to your customers, and you're giving them the right advice to use those opportunities for their pension planning. I suppose encouragingly this year, we're also seeing return to growth on some product lines that were a bit weaker last year. Investment bond business, savings business, both very strong business volumes coming through this year. And I think that's probably a result of strong equity markets, the work you're doing with your customers, but also the fact maybe some of those inflation, cost of living issues have eased back a little bit. And I think as we look forward into the year, there is the possibility of some other things creating new opportunities for us. The SFT, Standard Fund Threshold, is under review, as is the life insurance exit tax regime. And I know Brokers Ireland in particular have done a lot of work at bringing those issues to the fore. And we're hopeful there will be some changes there as the year progresses. I suppose finally this year, you're all aware the pension world, as part of pension simplification, is becoming more and more complex. So we've got auto-enrollment coming in, we've got the move towards master trusts, we've got the changes on PRSAs. There's so much going on. And what all of that means is the need for advice for independent advice from brokers is growing more and more, both for individuals and for employers as well. And that trend will continue this year, and Rose Leonard will talk a little bit more about changes in the pensions market this morning. But to start things off today, we're going to hear from Zurich Life's Chief Investment Officer, David Warren. And David is going to give us some thoughts on what matters. So please welcome David.
Thanks, Jonathan, and good morning, everybody. You can see that Zurich has a fondness for nature-based graphics. We had Jonathan wistfully looking up at the waterfall he's going to climb. I think that's trying to depict me and the market wall of worry. Wait until you see what's coming after me from Guy Miller. When I saw it first, slightly startled, and it did remind me of a slight quote from Oscar Wilde, who said that for one person to skate on thin ice on their own was quite dangerous, but to bring a companion was downright irresponsible. We'll see that in a few minutes. I'm going to talk a little bit about, we sometimes refer to them as the 3 Ps: performance, people, and process. Later on, we're going to have a panel of people, some of the senior colleagues from the investment team. They're going to talk with Terence Deacon about some of the current topics in the market. Later on, we're going to have Ian Slattery talking about performance, a very interesting perspective on performance, the life cycle of an investor over the last 30 years, with a lot of nostalgic material for those of us who are around then and can remember the events of the time. I'm going to focus a little bit on process, which is very important to us. This is something we've been using for donkey's years at this stage. It's a slightly stripped down version of it, but it's a way of us communicating how we do things. As Jonathan said, we're active investment managers. We take a top-down approach to the world. We start with the economic cycle. We look at how that drives the asset cycle, bring us into asset allocation, all the way down to security selection that the portfolio managers do, and down to those individual holdings at the end. On the right and the left are the things that keep us safe. We're always cross-checking with market developments. We need to be aligned with the market. We don't want to fight it. That's not our style. That won't make you money in the long term. So we need to cross-check continuously and be aligned with the markets. On the right-hand side, we want to be very careful about the risks we take. We want that to be calibrated to conviction and our degree of confidence in what's going on. So being attuned to risks, both within the marketplace and within our portfolios, absolutely fundamental. Now, we normally have a lot of other text accompanying this. I've tried to reimagine that in the following sets of, I don't know what we're calling them, colored dots or bubbles or something. But essentially, I'll try and say what we think we focus on and what matters for multi-asset investing. First thing up is outcomes. That's probably self-evident, but the key here is what I'm trying to say in the smaller text. This is not about us being clever or being right or being vindicated. It's about making good decisions in a timely way, in a calibrated way. We're always thinking and talking in terms of medium and long-term factors, but how we deploy that needs to be carefully done, and that's what I mean by outcomes matter. So we want to make money rather than be right. Earnings matter. So, equities are the bedrock of most multi-asset investing. For that, it's all about earnings. Earnings are driven by the innovations of firms, by structural factors, technology, the internet, electrification, these days responsible investment, climate change, macroeconomic factors, the level of growth, fiscal policy, interest rates. Bonds matter. So bonds matter in their own right, be it sovereign or corporate bonds. They matter in their own right as an important element of multi-asset investing. And these days, thanks or courtesy of the developments post-2022, bonds are now again a realistic alternative to equities, or at least a viable part of multi-asset investing. So some of you may know, in our own asset allocation in the last 3 or 4 months, we've probably got to a more balanced position, less equities than we had. It's probably the first time we haven't been overweight or had very, very large allocations to equities. We've been able to scale those back and not suffer a performance detriment because bonds now offer viable alternatives within the multi-asset environment. Bonds also matter because they provide the discount factor that drives the valuation of equities. Okay, valuations matter, absolutely. So whether it's the valuation of the assets in isolation, bonds in isolation, equities in isolation, or one versus the other. We spend a lot of time talking about valuations. And the other point about them is they're inherently volatile. These are not fixed, unfortunately, perhaps. Way back at the start of my career in another firm, somebody said to me, if only the price-earnings ratio could be 10. And by that he meant just a fixed number. And he said, well, then we could focus on the E part, the business models, the earnings of the companies. Well, it's a lot more complicated than that, unfortunately. The E is volatile, and the price that's attributed to a given level of earnings is also volatile. But that's the kind of volatility we're used to. That's the kind of volatility we're immersed in day to day, and we know how to handle it. Risks matter. I mean, a lot of people conceptualize risk as volatility. For us, the volatility that's there, whether it's the economic cycle, the asset cycle, whatever, that's the volatility we have to navigate through. Risk is something slightly different for us. It's the vulnerability that can come from extreme valuation, and that's the risk we're worried about. Valuations are risks which are unconnected to the economic or the asset cycle. So we're very attuned into risk, especially extreme risk. That can be on the high side or on the low side, but particularly on the high side. So for us, risk is about valuation rather than volatility. Judgment matters. I guess I referenced the P already, and we're going to hear from some of the colleagues in a short while about their thoughts on the current day markets. Unfortunately, or fortunately, maybe it's fortunately, there's no formula here. Like what we do, we believe is art more than science, but what we certainly know we're trying to do is to synthesize an awful lot of information into ultimate judgments. We should buy more or sell more, either security level, sector level, or asset level. So judgment really matters. People matter, the experience matters, and us working collectively. It's much more important than perfect knowledge. Perfect knowledge will have you focusing on the wrong thing, giving much too high a weight to one particular thing. This is multifaceted, requires judgment, and requires teamwork. The last piece is something we don't talk about normally in terms of our process, but I put it up here and I put a question mark beside it. Now, I think the lads are going to talk a little bit later about some more specifics here, but it is a topic that has become in the zeitgeist in the last 2 or 3 years, market concentration. We've seen and we're aware of a lot of very high capitalization technology stocks, particularly in the US. They've got nice taglines, FANGs and Magnificent Seven and so on. So there is, in the last number of years, has built up a concentration of a certain type of stock in the markets. We don't think that's inherently good or bad. It may be purely a reflection of really successful business models. So there's nothing inherently risky per se about concentration. Risk for us is all about valuations. So the guys will talk a little bit about market concentration in a short while. So that's just a slightly different perspective on what matters for us in terms of multi-asset investing. These are the words, excuse me, these are the words that we normally use to describe our process. Essentially, I've tried to repackage old goods in new wrapping in the previous bubbles, but essentially it's the same thing. We have a time-trusted process. It delivers. We're very, very attuned to the risks within our portfolios, the risks within the markets, especially those which are stemming from valuations. And on the left-hand side, we want to be aligned with the markets, not fighting them. And what that means is if equities are rising, we want to have a strong allocation to equities. We certainly don't want a low one. Similarly, if bonds are on the move again, in terms of bond prices increasing, we want to have as much bonds as possible within our multi-asset funds. So we've been recalibrating our asset allocation in the last number of months, reducing equities a little bit from very high levels that we've had for a number of years. Fortunately, to have that, and it's contributed well to our relative performance. Bringing back up bonds, which we've had very low allocations to for many years, again, fortunately or correctly so, and we've gotten to a more balanced position. From here, let's see, the markets are at a fascinating juncture. The guys will talk a little bit about some of the detail there, but we've got lots and lots of big cross currents happening. Lots of elections this year, potential turmoil, potential volatility, potential turning points as a result of those. So look, we're watching and waiting very, very carefully. We talk about a lot of these themes very regularly. We have our asset allocation group met yesterday. Again, we're talking about what's happening today, but also the bigger picture, medium to long term. And probably if I try to, again, distill this down a little bit further, I come to another 3 A's in this case. Activity, we're active managers. That's very important to us. That's the way we believe we can add value to customers' portfolios. We're never static. We're always looking. We're always thinking. That doesn't mean we're always acting in terms of moving assets or sectors, allocations and stocks, but we have a bias for activity. We take account of the medium to long term a lot in our calculations, but we're very assiduous, careful, calibrated in how we deploy those ideas into our portfolios. Aligned with the markets, I know I've said it now 2 or 3 times, but that's really key for us. We can't fight the markets. We shouldn't fight the markets because that's not the route to long-term performance. We need to be really careful about risk. So we want to be attuned to risks all the times, portfolio level risks and market level risks. So the combination of those 3, activity, alignment, and attuned, are going to keep us safe and hopefully continue to help us delivering good performance. Now, as part of our whole process, I've mentioned the economic cycle and the assessment of that. And that brings me on to our next speaker, who hopefully is with us. Here's his graphic, slightly scary. He's skating on thin ice with an ellipsis after it. He's going to explain to us what that's all about. But this is Guy Miller. So Guy is a long-standing colleague and friend of ours. He is the Zurich Group's chief economist and chief market strategist. He heads up the market strategy team in Zurich Corporate Center, very familiar to us, all the colleagues, including Guy. And I'm sure he'll have a very, very interesting set of slides for us, and hopefully he's coming up now. Cue Guy.
Hi, can you hear me?
Well, we can kind of hear you, Guy.
Hey, well, listen, sorry.
That's a bit better. It's a bit better.
We just had a fire alarm, so I was evacuated from the building and ran home. So I feel like the skaters that you see. So I apologize for being a bit out of breath here. But maybe, David, I guess that's the cue for me to take it over, right? So I hope you can hear me. I can't hear anything, but maybe just starting off by the screen that you can see here. These skaters are skating along, blue sky ahead of them. All things looks pretty good. But a couple of things, and the reason we called this presentation Skating on Thin Ice is that you can also see just below the surface, there are a number of fissures and I guess, ripples in the ice here. That's reflecting the difficult environment that we have with inflation still problematic, rates high for longer. We've got global elections in full swing right now, India currently. And of course, we've got geopolitical events that any one of these could lead to this ice breaking up and these skaters having a bit more of a challenge. But nonetheless, things look pretty good so far. If we can turn to the next slide and let's get into some of the details behind that. Well, what are we really thinking? Our view here is that the global growth picture is not bad. We see kind of trend-like growth this year and next year. And I kind of characterize this as a period of normalization, digesting the excesses and the disruptions from the pandemic, which still linger, and we'll come on to that a little bit later on. But nonetheless, we've got growth in China, likely to be around their target, still problems around the housing market. In the case of Europe, we have anemic growth, but nonetheless, a growth dynamic that we think is at the margin getting better. And the big surprise since last year when we met is the United States has been really in stellar form, growth significantly above trend, 2.5% last year, still quite strong in Q1. But nonetheless, we think that is going to be a theme this year where growth slows towards the back end of the year and into next. Now, what does all of that mean? Well, it means that core inflation, although it's proving to be somewhat challenging to squeeze it lower, we do think we get the direction of travel towards the central bank targets. And as a result of that, we do believe that we're going to get interest rate cuts coming through this year from the ECB and the Fed. From a market perspective, we suspect that government bond yields will grind in a little bit lower, up at these kind of levels towards 5%. In the case of 10-year treasuries, it becomes problematic. And then grinding lower with rates coming down, we think, again, from an equity market perspective, returns are going to be quite decent. And this currently is our favored asset class, particularly against credit, which we'll come on to, and bonds. Geopolitics, I said, can mess things up quite easily, but so far, at least, it's being well digested. Now, turning to the next slide, around the global growth dynamic that we're seeing. I think this really comes back to the legacy of the pandemic over the last couple of years. We've had this two-speed world economy. We've seen in the terms of the manufacturing side of the globe, weak manufacturing activity. Global goods trade has been, again, very low and contracting in some cases. Industrial production has been under a great deal of pressure. And of course, all of that stems from the massive demand, oversupply in many cases that we've seen following the pandemic itself. So any country that is heavily exposed towards the manufacturing goods trade has really been having severe headwinds of late. Contrary to that, the service part of the global economy is in pretty stellar form. We're seeing people eating out, they're traveling, they're using hotel and leisure facilities, and that part of the economy is doing well. So what am I showing you here? Well, it kind of, in a nutshell, sums all of that up. We're looking at the purchasing managers indicators. These are quite good, coincident leading indicators for the state of the economy. And what I'm showing you is anything above 50 is expanding, below 50 is contracting. The blue line is the German manufacturing part of their economy, or the PMI for manufacturing. The red line is Spanish services. And you kind of see pictorially what I was just describing. Germany has been under the cosh for a year or two now. We've seen not only have they had the problems about the higher energy prices initially, but we've also seen structural issues that face Germany and the industrial side of the economy, particularly coming from China. So whether it's manufacturing, whether it's the auto sector in particular, we're seeing, again, very lackluster demand, and that has put pressure on the German economy more broadly. And again, the flip side of that has been the Spanish economy has seen the benefit of the service activity that we're seeing. Spain is the second most visited country in the world. And again, they're benefiting from an increase in tourism, increase in broader service as well. And I saw a very interesting statistic just the other day that pointed out that prior to the pandemic, US households in an average year, about 10% of them plan going on an overseas vacation. We always used to make jokes about passports and US travel, but now that's changed. So the latest survey shows that 21%, double the average prior to the pandemic, of US households intend taking an overseas vacation in the coming 12 months. And again, that is something that I think is going to fuel the service part of the global economy. Now, that in many ways is a problem if you are some of these central banks. And if you go on to the next page, you can begin to see the reason for that. Now, this is the Mount Everest of inflation that you've all seen and know about. We saw the massive drive up in inflation post-pandemic, of course, as there were shortages and outages. We saw higher energy, food prices, goods prices more broadly. And then, not surprisingly, to be honest, we saw the dramatic decline in these CPI headline numbers as these came off. But the point I'm circling here is really over the last 9 to 10 months in the case of the United States, that blue line has moved sideways. In other words, we're really not seeing an improvement in the CPI inflation level at the headline level in the United States. And you can see more broadly as well across the globe, there has been a more challenging period, or as they call it, that last mile to get inflation to central bank targets is proving a little bit harder, or quite a bit harder, I would say, than many had hoped, and indeed the central banks themselves had hoped. So why is that? And if we go to the next slide, I drill into that US inflation. So the blue line that you can see here is that US CPI number, and you can see that kind of flatlining over the last 10, 11 months or so. You can also see what the drivers of the decline in inflation have been. We had this marked fall, food, energy, core good prices. You can see the colored bars there. So much so, in fact, that we've had deflationary forces in many cases in part of these core goods. The same things that is negatively impacting the German economy is positively impacting the global inflation story. And energy prices as well, you can see until very recently as well, have been actually falling, helping the inflation story. But that's not the point of the chart. The point of the chart is look at these gray bars. This is looking at core services inflation in the United States. And it's not falling. If anything, at best, it's flatlining. And you could say even it's maybe ticking up a tad. In other words, that really hasn't changed from the last 2 years. And this is a problem the Federal Reserve has. Many parts of the economy are indeed normalizing. Inflation, even the way it's calculated on a year-on-year basis, is arithmetic, it falls off. But the problem they have is that there's simply too much demand for services. The US economy has been too strong. I mentioned these households planning foreign travel. Now, the story is not quite as obvious in other parts of the world, but even in Europe, we're seeing a service inflation component between 3% and 4%. So again, this is partly a global phenomenon where we're seeing the service part being the most challenging for these central banks. So what do they do about this? Where are we currently? And if we go to the next slide, you can see my kind of famous stairway to hell chart rather than heaven, which shows you globally, whether it's the Mexican, Brazilian central banks, or here in Switzerland, you've seen this progressive move higher, of course, to try and slow demand, to try and slow the economies, to pull inflation back down to target. And what's interesting, of course, many of these emerging markets were first to move. You can see that they then flatlined, plateaued at a high level for about a year. And now we've seen, in the case of Brazil, steady moves lower. In the case of Mexico, we got a surprise just a week or so ago by them cutting. That wasn't expected. What's interesting is that the bottom part, the green line, this was the Swiss National Bank. Again, that surprised the markets and most economists by being the first of the G10 countries to move. They obviously felt confident enough that inflation was well enough contained in order to do that. But the reason that this is so important is that, these numbers, they don't look too dramatic. But if you're a household, if you're a company, then they really do matter. When you think about the corporate side of the equation, whether you're in the United States, the UK, or elsewhere, you're finding that your funding costs have gone up dramatically. You're less likely to invest. And if you've got a refinancing wall coming up against you, then you're finding the cost of doing that and the sustainability, the carry cost of that debt is a real challenge. If you're a household, higher mortgage costs, higher credit card costs, all of these are a real struggle, even if broadly inflation is beginning to wane. And you might remember, I think I showed you a chart last year about US bankruptcies that we were concerned about. Well, we had 201 medium to large size companies go bust last year in the United States because of this. Now, what does that mean in real terms? Well, it was the fourth worst year in the last 25 years of bankruptcies in the US. The only worst periods were during the pandemic and during the financial crisis. So it shows you that even though things seem optically pretty good, these higher interest rates really do matter for households and companies. Now, turning to the next slide, we think about what are expectations for interest rates. And you have to think about this a bit kind of upside down. This is the number of basis points of rate cuts that have been expected by the financial markets by the end of this year. You can see that in the January period, the bottom of this kind of U shape here, investors were thinking that whether it's the ECB or the Fed or the Bank of England, there was going to be about 170 basis points of rate cuts. And this was fueled, of course, by a very dovish sounding Fed back in December that was implying that they were on the verge of pivoting. The market was pricing that in. But what you've seen since January really has been a systematic pricing out of these rates. So in other words, as that inflation number has shown itself to be more problematic, the market has become less and less of the view that these rate cuts will come through. So much so, where I actually had to update this chart, this data was about a week old now, it's continued to move higher, that there's only about one rate cut now expected by the Federal Reserve in December of this year. Still, the ECB are expecting to move rates lower, but you can see a dramatic shift from 170 basis points of rate cuts to about 25 basis points of rate cuts going forward. Now, why does that matter? So let us turn briefly to the financial markets and see what all of this means as an investor. And on the next slide, hopefully you can see, again, a slightly different version of that slide that I just showed you. So the red line is looking actually at the number of Fed rate cuts. You can see this on the right-hand side. And as I mentioned, it went from thinking about 7 back in January to now thinking there's only about 1. Again, if you updated it, that red line would be a bit lower. The blue line is the S&P 500. And the point around this is that if you look at the correlation, particularly since the kind of the October-November time period, as the market thought there was going to be really quite significant rate cuts, in other words, this red line was moving up, expecting 5, 6, 7 rate cuts. Of course, that helped the S&P 500. It helped financial markets. It justified higher multiples that investors were prepared to pay as the discount factor was likely to be coming down. So, not surprisingly, you saw, I think, the markets responding to that very dovish messaging. Finally, we could see light at the end of the tunnel. But what's interesting is really what's happened since around about February this time. You can see there's been a divergence. As I said, the market was pricing out the number of rate cuts, but actually the blue line continued to move higher. So again, the great fear that less rate cuts would disrupt the bull market were ill-founded. So why was that? And I think part of the function was the reason then that the rate cuts were being priced out was because investors were embracing the idea no longer about US recession, but the concept of a soft landing if there was going to be a landing at all. And you can see, again, thinking that way, the view as well, if the US economy is good, if the global economy is really quite good, that means that actually company profits, margins, the earnings generally could actually be quite decent. And therefore, that justifies this market continuing to move higher. Now, that is a pretty decent story and certainly something that I would endorse. But what's happened was, again, investors are fickle. There's been a bit of a change in the last 2 or 3 weeks. And you can see that as that red line continued to fall, suddenly the blue line began to change course as well. And I think a key reason for that was not issues around the geopolitics, but a function of this notion, actually, maybe in order to get inflation to target, maybe, just maybe, these central banks have to do what we worried about a year ago, which is break the economy, move rates higher, even higher, in order really to choke off that demand if they're really serious about getting inflation back to their targets. And that's something the market has been having to digest now for, I think, a couple of weeks. It's one of the reasons why the market has pulled back as it has. Now, our own view around this is that this is kind of the pause that refreshes. As I said right at the beginning, we are not expecting rates to go up. We are expecting the direction of travel to be lower. We're thinking the ECB cuts in June. We actually think the Fed will cut rates in September. And those of you who watched the Fed press conference last night, I think would have been encouraged somewhat. The Fed chair, Jay Powell, made it clear that they're not considering moving rates higher. He really came across as a man with a mission to move rates lower, provided he gets any whiff of the fact that inflation is indeed coming down. And I think that's quite encouraging, because I think were inflation or were interest rates to have to be jacked even higher, then I suspect this would be a severe problem for all financial markets. But it's not something that we're expecting. We're taking this as a pause There may still yet be a bit of downside to clear out some of the excesses, but nonetheless, a market environment that we think favors equities. Why do we think it favors equities? Well, if you turn to the next slide, we're looking at the credit markets. Credit markets have, this is looking at US investment grade corporate spreads. You can see that the credit markets really are in a kind of a very privileged position, it seems. In our opinion, there's no risk premium being offered. You can see spreads are pretty much at their lows, which means that if things do turn out well, if interest rates do come down, if corporate profits are good, there's not a lot of room for these spreads to tighten much further. But if we're wrong, and if indeed the market has to cope with higher rates for longer or perish the thought even higher rates, the risk is that actually these spreads could move up quite quickly. So in other words, there's an asymmetry between the credit markets and equities. Equities are likely to go up. Effectively, equities are not constrained or limited by any kind of cap, whereas there is a floor to corporate spreads. And indeed, on the way down, as you can see here, when credit moves, it can move really quite sharply. A 5% equity pullback doesn't really worry the credit markets too much. But if this looked like being more than a correction, if this looked like a really rolling over of this bull trend, then I suspect these spreads can move quite sharply higher, and the market would then underperform the credit markets. Whereas, again, bull market continues, I think credit underperforms equities too. Very briefly, the next slide. Just looking at the bond market, because again, our view had been that bond yields would come in. What I'm showing you here is 10-year treasuries versus US nominal GDP growth, the red line. And there is a correlation between these, not maybe so tight, but you can see broadly. And the point of this one really is that this breakout of this multi-decade trend we had seen in bond yields, the question was always, is this now the start of a prolonged bear market? We suspect, and we thought this last year, that it's not. We tend to think, you can see the two little red dots there. This is our own forecast for nominal US growth. So we are, as I said at the beginning, expecting that to come down. Growth being weaker plus inflation coming down, that should allow these bond yields to come in as well. Not going back, we think, into that down track. We think there's enough reasons why bond yields will remain higher than it was pre-pandemic, whether it's around the inflation dynamic or the debt levels. But nonetheless, that easing back of bond yields, we think, is positive for the equity markets more broadly. And then if we turn to the last part here that I've got, which is, we're often asked a question about how can financial markets do well when every time I turn on the news in the evening, things look so bad. And of course, the point is that kind of financial markets are not too sensitive to the human realities of war and conflict. And what I'm showing you here is the Brent oil price over the last year or so. And the oil price is really the lightning rod for geopolitics in terms of how it really affects the real economy. And in terms of the vertical dotted line, this was October the 7th with the Hamas attack on Israel. But what's interesting, and again, if I updated this morning, oil prices have fallen further, is that they're broadly in this range, $75 to $95. You know, over the last year, the OPEC plus countries have actually constrained supply somewhat. So despite all of that, oil prices seem very manageable. If you're a producer, this kind of range is quite helpful from a profitability perspective. If you're a consumer, well, we've had many periods in history where we've been significantly higher. You can live with that. And the point is that nobody, in terms of the oil market pricing at least, is expecting the supply of oil to be materially disrupted. In fact, you can see just on this chart, since the direct attacks by Israel and Iran on each other, even the week that we had this first ever joint strikes, the price of oil in that week actually fell, it didn't rise. So in conclusion, the very last slide, you'll be pleased to hear, our view is somewhat sanguine. We think there should be a risk premium in markets because there are many risks out there. But broadly, the growth dynamic, unexciting, growth holding in roughly around global trend. The US looking a bit weaker, other parts of the world looking a bit better. Inflation, that last mile, will be a challenge, but we should have known that. The road is bumpy to get there. Nonetheless, we think that direction of travel is there, which will allow policy easing by the ECB, we think, in June. And ultimately, the Fed will, we think, cut rates most likely in the September time period. All of that, to me, suggests that the financial markets, of course, you would expect them to be bumpy. They should be bumpy in terms of how they interpret and price data. But nonetheless, this is not a bad environment for financial assets. And it's particularly, I think, a reasonably good one for equities in the global context and across financial assets versus corporate credit and government bonds. So I apologize for this very out of breath presentation. I'm glad I was able to run up a very steep hill. I hope in future I will be able to enjoy you and join you in lovely Dublin. It's been a while. And on that note, I think I pass back to Terence.
Thanks, Guy, and good morning, everybody. And thanks again for coming, whether you're in the room or you're on the live stream. So the next section here will run for 25, 30 minutes or so. And our job here is to delve into some of those macroeconomic issues that both Guy and David have been talking about, and more specifically to try and highlight for you and explore a little bit how those things are affecting our own portfolios. So mostly we'll talk about multi-asset funds, about the Prisma range of funds when we mention fund names, because I think that's the most relevant thing to most of you. And for the purposes of this discussion, I have the three wise men. Philip Duggan, who is the Deputy CIO and Credit Specialist. We have Michael Kelly in the middle, who is our head of European equities. And so successful was he last year that we had him back again this year, Damien Mead, who's our head of North American equities. So we'll have a discussion and see where it brings us. We're hoping to keep it relatively informal. We'll see if we manage that. Hopefully we will. But I'm going to turn first in a direct attempt to kind of pick up on some of the points that both David and Guy were making to Philip on the bond side and on the macroeconomic side. And I think, you know, there's been a profound change. David mentioned it. The world has changed completely for bonds. Philip had 10 years off because we didn't do much with bonds. All the performance came from equities, but now he's busy again. And I think this chart probably explains it as well as anything can. So Philip, maybe if you'd explain firstly what we're showing here on this chart,
Sure.
And then maybe expand on that in terms of what the implications of that have been for our asset allocation.
Absolutely. Thanks, Terence, and good morning, everybody. I started my career in 2000, and at the time, Japanese rates were negative. I remember thinking it was pretty strange. You lend people money, and they gave you back less, which was obviously, you know, not exactly economics 101. And then, as Terence shows here in the chart, we came to a period when this applied to a very large percentage of the world's debt. So negative yields persisted for several years, particularly in the Eurozone, which affects us all as Eurozone investors. But that's changed dramatically over the last few years. You can see it's gone from about 18 trillion down to zero. What does that mean for us as investors? It means that where we have discretion in multi-asset funds, we've taken this opportunity to add bonds of various types of duration. Like the path of yields higher for holders of bonds can be unnerving. But if you take, say, a short-dated bond portfolio with duration of a year or so, the move higher of 3% in yields, which is what we saw in the Eurozone, costs you 3%. But then once you get there, if yields stay up there for the next 4 years, you earn 3%. So the journey is a little unnerving, but after 5 years, you end up with a net return of 9%, simply speaking. If yields had stayed at a negative level, minus 50 basis points, over 5 years, you earn minus 2.5%. So you don't have the volatility, but you end up in a worse place. So there's kind of nuances to the move in yields, and we very much think for the lower risk portfolios, this puts us in a position where you can earn a decent return out of cash, a decent return out of short-term government bonds, a decent return out of short-term corporate bonds. But then probably brings us on to my equity colleagues that from a comparative perspective, if you told people how much yields would move 5 years ago, people thought, okay, maybe this will unnerve equity markets, but like exactly the opposite has happened, and the guys can give some colour on that, I'm sure.
Yeah, exactly. So I don't mind which of you goes first. Michael, you seem keen. Yeah. So just picking up on Philip's points there, what are the implications on our equity books?
Yeah, thanks, Ernst. I think the key why equities have probably held up better than expected is that the earnings momentum within equities has been strong. The economies have remained resilient, and I think corporate balance sheets are quite strong as well. So a lot of companies are beneficiaries of higher interest rates because they have a lot of cash on their balance sheet. Corporates also have fixed term debt, so they're not necessarily experiencing higher funding costs as of yet.
And just to add to the point, and Michael mentioned maybe what has changed from now versus last year, since you referenced I was here last year. So last year the focus was very much on technology and the emerging AI trends that were very powerful last year and continue to remain very powerful this year. But David mentioned earlier on how there's been a lot of focus in the market about concentration amongst the top FANG names in the US. But in actual fact, what we're observing is the market is broadening out over the past year, and we've broadened out the portfolio to take advantage of existing trends such as the AI and technology, but also to take advantage of other trends and new emerging trends that we've been very active investing in the portfolios, such as in industrials and infrastructure areas in the US in particular. There's been a big focus on the negatives from the deficit in the US, which is part of the wall of worry that David referenced. But the flip side of that is we get the opportunity to invest in those companies that can profit from a lot of money that's been spent in the US, reindustrialization, reshoring, bringing those businesses back to the US, and there's plenty of names there that we can reference. So as being part of Zurich, we have the advantage because of its longevity and its scale in Dublin that many management teams, they come, and when they come here, they'll look to meet us. So one of those companies, for example, that we're invested in is a company called Clean Harbours, where the management team came to Dublin to see us. So this is a company that remediates hazardous waste. And as the US is bringing more companies back from abroad and more chemical companies are coming back, this company is a leader in dealing with that and also hits on the sustainability theme. So we get the opportunity to invest in that. The company had results yesterday, and because they have so much business, they got the opportunity to increase prices, and it's a bit of a positive flywheel they've got in terms of profitability. But I know, Michael, there's plenty as well on the European side where we have various thematics that we're invested in.
Yeah. CRH is probably another example of a company benefiting from increased infrastructure spend. I know it relisted into the US last year, but it's still quoted in the UK. So we're invested there. It's 40%, 65% of its exposure is to the US. One of the reasons why it relisted in the US.
Yeah, I mean, is CRH even an Irish company anymore, or is it now a US company, Michael? It's one of those 50-50 things. Isn't it?
Yeah, exactly. But I suppose the predominant revenue driver is the US. And infrastructure spend. I think one of the things in the US is that a lot of the infrastructure is quite old and dated, so a lot of the spend is needed, and it's probably it's bipartisan party support for the infrastructure bill. So even with changes in the election, with whether Trump or Biden come in, there's probably a road for increased infrastructure investment for the next 4 to 5 years.
Yeah.
And on that front, then the market will wax and wane, but it's our job responsibility to identify some of these long-term trends, which Michael mentioned, which is the weight of money that's going into infrastructure in the US. And the obvious trends are obviously in AI, which remains a very powerful trend, but there's others that are equally powerful but may not get the same attention. So there's a tremendous amount of spider's web of companies that get benefit from that. So because, first of all, we think of, semiconductor plants moving back to the US, but then a lot of the technology companies, they need data centers to be built in the US. This means a lot more energy would be used. And then there's lots of companies, such as, for example, CRH, which may help with the cement build some of these data centers, and other companies which may help kit out these data centers and make it the opportunity to invest in them. Another example of a company that we've had the opportunity to meet and met them several times, the management team, is a company called Carlisle Companies. They make roofing in the US, and this may sound very basic business compared to the AI, but that's
we all need a roof.
Yeah, it's all about having a sort of a mixture of companies within the portfolio with tremendous long-term opportunities. So in the US, the characteristics is many of the buildings are made of wood, homes, and there is a re-roofing cycle, and it happens that this is entering a good time because about 10 years ago there was a lot of new buildings and now they need to be re-roofed, but also these companies help in energy efficiency, and there's going to be big demands put on energy because of a lot of the AI, which is very energy intensive, and this company has the benefit of being able to cater for that, to reduce energy intensity, and also increase pricing. And I know that's a big area for you guys in Europe as well too, in terms of energy intensity.
Yeah, no, exactly. And even on the data center point, I think there's a lot of capex, as Damien alluded to, going into data centers, etc. I think there's estimated over 200 billion to be spent on data centers this year alone.
And so 20% of energy usage in Ireland is data centres for a small country.
I was just going to say, and there was me thinking all the data centres were in Ireland, because we give out about them, about how much data
just shows some of the impact,
how much power they use.
You start off with a story, and then an impact is over here, and for us as investors, there's opportunities over there.
And it's interesting where these thematics can come out of nowhere. I mean, we all sit down at the start of every year and we wonder what the year ahead's going to look like, and what are going to be the big stories, and we do that as a business, but you guys do it at the investment level. I mean, a year or 18 months ago, nobody was talking about thinning drugs, obesity drugs, diabetes drugs. It's suddenly a huge story. Oprah Winfrey's all over it. It's in the news. When she's in the news, it's going to get publicity. Do you want to pick up on that just for a minute? It's just to tell people what that's about, in case you missed it.
Yeah, so we're invested at the moment in two of the main drug companies that have this drug that was initially set out for diabetes, but also can be used in obesity. We've all heard maybe of Ozempic and various other brand name drugs. And one of these companies is in Europe, made by Novo Nordisk, and the other by Lilly in the US. So it seems to be a tremendous, broader, long-term thematic. But also we get the opportunity as well to look at those other companies surrounding this that may also be beneficiaries, or where the market has taken the wrong view. So for example, last year when a lot of these drugs were first announced, straight away the market marked down a lot of companies that were more medical devices, so hip replacement companies that dealt with sleep apnea or issues that were associated with obesity. And so there was a huge fall in a lot of those companies because of the knee-jerk reaction. So we got the opportunity then to invest in some of these companies because, of course, over the past few years, the last year, the market has given thought to the idea that because we have an aging population, there'll still be a strong need for some of these companies' remedies, such as sleep apnea, for example, a company called ResMed, where we have an investment, and they're the market leader. And over the last year or so, it's become clear that these obesity drugs can be used in tandem with their own products, and the two of them together can be quite positive for the user. So this is an example of a trend that was there last year that has continued into this year, and Jonathan referenced earlier on in terms of brokers, some of the businesses factors that continued into this year. It's the same in the market, but also in we've seen some new factors emerging, and one of those for us on the US side was on the utilities in the US. So with all the discussion about semiconductors and AI, what was neglected initially was the huge intensity of energy use surrounding this, and that gave us the opportunity to invest in some of the utility companies in the US focused on sustainability and renewals, which could be a solution to some of this issue that's emerging because of the high energy use of some of these AI initiatives. And I know in Europe as well, you're seeing some of that as well, Michael.
Yeah, no, definitely. And just maybe to pick up on the new drugs for diabetes, etc. Novo Nordisk now is the largest company in Europe. And there's going to be a lot of growth in terms of production growth. The biggest issue at the moment is supply of that drug, and they're investing a lot they're planning to increase production by tenfold in the next couple of years, and they're investing a lot.
Are they in Ireland?
I'm not sure, to be honest.
Just wondering. Yeah. We have a lot of the big pharmas. I was just wondering if we have them.
Yeah.
We'd better get them if they're not.
Yeah, exactly.
The products.
No, their main operating hub is in Denmark, so I don't think they have much presence in Ireland.
Okay.
But it's an interesting point that Damien picks up on. Opportunities for one company can be a threat for another company. So you have to look at it, the whole picture. And another area of concern for these drugs is that people are going to be eating less, and a lot of food companies have derated it quite a bit on it, and especially snacks. People are less inclined to eat snacks, so it's more healthy snacks and stuff like that. So it's been a thematic within the market.
I honestly didn't think our discussion would go in that direction. You just never know.
You just never know. Developed terms. If you asked somebody 10 years ago, Michael, where would the highest market cap company in Europe be based? You got pretty long odds on Copenhagen, I would say. So it's remarkable the way things can change and how quickly they can change.
Yeah.
Looking as we speak about a lot, we try and stay in tune with markets. We don't try to get too much into the predictive game because you can, get overly occupied with that. It's trying to follow the dynamics as they evolve and try to take advantage for the customers that you bring to us.
Yeah, let's just change gear a little bit. We'll just go onto this one and back to the lads immediately to my right, perhaps more so than Philip. I mean, both David and Guy mentioned the broadening out of the equity market at some point in their remarks, which we like to see. I think it's fair to say, but I'll let you guys expand on that. We don't want to see all the performance coming from a handful of stocks. It's fine if we have them, I guess, but we don't. It's not a particularly healthy thing for the market. But this slide here is it's short term. It's year to date. It's just since the turn of the year. World equity sectors, and I hope you can all see that on the closest screen. And what strikes me about this, we used this last year as well, and what strikes me about the difference between last year's and this is that now, we have 10 sectors in green and 1 in red. So we have a broadening out. We have lots of sectors rising. All the performance is not just coming from one small area or 2 areas. So that's a plus, right?
Yeah, no, it's healthy to see a broader range of sectors driving the market. I think one of the reasons is probably the economic growth's been a bit better, and a rising tide lifts all boats.
As Guy mentioned, yeah.
Yeah. So that's definitely helped. Manufacturing, I think we're starting to see, in terms of what the drivers of the economy are, I think we're starting to see some tentative signs of green shoots in manufacturing. A lot of excess stock and inventory was built up over COVID when supply constraints were there. Purchasing managers changed from just-in-time purchasing to just-in-case because we're fearful of running out of inventory. So that's been a prolonged headwind on manufacturing, but we're starting to see new orders picking up, which will be the first signs that maybe manufacturing is going to improve, and that's helped some of these sectors, maybe like energy, materials, etc., to do a little bit better.
Yeah.
And the third from the right then is utilities, as I mentioned. And David mentioned earlier on about our approach about being aligned to markets and actively managed. So this is an area which we've been underweight, which meant we won less than the benchmark for many years, but we've recently increased the weighting there as it's become a bit more apparent that the issue around the growth of AI will be a shortage of energy, and those companies that can help you in that need can be quite richly rewarded. So we have looked to, and we've added more into that area. So more broadly, we've taken from some of the profits in the tech area while still remaining exposed to some of the key trends there, and broadened out our own portfolio, and that also includes into banks. So for example, US banks, where we had been underweight for many years, and then last year obviously we had the issues about Silicon Valley Bank in March last year, which led to a huge derating in terms of the PE valuation of banks, and subsequently we believed that the valuations was tremendously attractive for many of these, and as Michael mentioned earlier on, and Philip, the US economy has kept going better than expected. So the combination of that together means that area is relatively more attractive than what it was. So we have chosen to be, I guess, agile and also aligned to markets by redeploying some of our holdings into some of those areas that can be less obvious but no less attractive in terms of returns over time. And the same in Europe, Michael. I think you've been playing European banks recovery.
Yeah. European banks have been a bright spot, I suppose, in terms of the market performance. There's the people are more comfortable about the asset quality when the economy is robust, and also they're buying back a lot of their own shares over the last while. So that's a change.
I was going to bring that up actually, not just in the context of banks, but just share buybacks are a big thing. We read about it a lot, hear about it a lot. It seems to be a huge thing going on both sides of the Atlantic. Michael,
yeah, no, definitely. It's probably the US was the first started the trend probably earlier than Europe, but Europe and other markets, Japan as well. It's about European companies are buying back about 2% of their market cap this year, so that's about 200 billion of share buybacks. So they're in buying back their stock every day, which is a supportive element for equity markets.
So to translate that into lay person's terms, they're buying back their own stock, so the stock becomes scarcer. And like any scarcer good, it tends to support the price of a scarcer good.
Yeah,
right?
exactly.
So it's not that much more complicated than any other good when you look at it through that lens. Same thing going on in States?
Same in the US. I think in the US has been a bigger feature for more years, so it's less likely to lead to greater changes. But certainly it does highlight a lot of companies have cash, and if they can use some of that to assiduously buy their own shares, that can be profitable for shareholders and also for policyholders.
Speaking of companies having a lot of cash, I think we have a nice slide here. I just have to find it, of course, which is this one, which talks to the colossal amounts of cash being thrown off by some of the big technology companies and what they plan to do with it.
Yep.
So big numbers on here. You might translate this for us a little bit, whichever of you feels like picking that up.
Sure, yeah, and David referenced earlier on how earnings are important. So we've had earnings from many of these top four. These are the top four US FAANG companies: Microsoft, Google, Amazon, and my eyesight. Meta. My eyesight isn't as good as it used to be. I need some of this medical technology services myself. So we see how that's growing, and that's been one of the features of the results, is how much more money they're putting into cloud computing and also the AI initiative. So they're generating that because they're getting the cash flow. So it's still, we are invested in several of these names, and they're still tremendously powerful business combinations. But also I mentioned the sort of spider's web of beneficiaries around that. So as well as the market more generally broadening out, there is a broadening of beneficiaries of some of the AI thematic, and we look to try to take advantage of that. And several of those would be companies that make data centers, or even the likes of less obvious names such as Cement Roadstone that Michael mentioned, who actually help also supply in terms of infrastructure. But there's plenty of other names around that. And while the market may have believed that this thematic was already well played out, as you could see from the numbers, it is growing quite.
The numbers are incredible, Jamie. Like 179 billion by four companies. Like that could be 6 times Ryanair's market cap, like, which is a very successful airline. Carries however many passengers. So you're trying to put the context of it. Sometimes can kind of get lost. You know that these companies we often talk about a lot are making so much money. They've got up an awful lot of value, but they're making so much money. It's almost hard to.
But what this says to me is they're not sitting on it. They're doing something with it.
But they're also giving it back to investors too.
Yeah.
So as well as this, like they're just huge numbers. Really.
But they're not standing still. They're not sitting still. They're investing for the next big thing, whatever the heck that might be, because we never know what it's going to be. But that seems to be what they're at. That's how I'd interpret that anyway.
Yeah, the important thing is that that capex is being covered by cash flow they're generating from within their businesses. Yeah. And as Philip said, they're buying back their own stock as well. Google last week confirmed a 70 billion buyback for this year as well. 70
billion.
Yeah, 70 billion.
Another big number.
Yeah,
another big number.
So just on the other beneficiaries of some of this spend, a lot of this, as we've mentioned already, is going into data centers, because AI needs a lot of computing power and a lot of data in the background. And one Irish company benefiting from it is Kingspan. So they produce elevated floors that go into data centers, which allows all the wiring and cabling to go beneath the floor, and also helps to put cold air underneath the floor to help air distribution within the data centers, because one of the issues is that they overheat and then the equipment can malfunction. So the likes of Kingspan is looking to generate $1 billion in revenue from flooring in the next 4 to 5 years. So it's a good growth area for them as well.
Yeah. And also at times we get, I guess people get distracted by a lot of the geopolitics or other news out there, and how can the market thrive when there's a lot of bad news out there? Turn on the TV.
Which Guy mentioned?
Guy mentioned. But I think this is tremendously powerful representation of the longer term investments that are ongoing currently. And we all often say also that the market is not the economy. So you have in the stock market a selection of some of the best companies globally. They're investing in these longer term trends, and they're going to continue to invest in them. And we get the opportunity to invest alongside it. And sure, the market will wax and wane over time, and we have to be very careful of the risks surrounding that. And at the moment, a balanced weighting of sectors and is probably wise. But here is an example that longer term, these tremendous forces are being invested, and there are plenty of names that can take advantage profitably of that.
Sure. Philip, the gold price, let's just switch direction for a minute. You haven't said that much for a few minutes. This is a big story. This is a huge story right now.
It's a big story. You can see from the price action on the right-hand side of the chart there that it's moved materially higher over the last number of months. Historically, a lot of people would have felt that gold would do poorly when yields will be higher. That obviously hasn't been the case. There's been a few reasons for this. There's been big central bank buying, especially emerging market central banks, in Asia and regions like that. People talk about dollar weaponization, that with the state of geopolitics in the world, geopolitics are a lot more fragmented than they've been for, post the Berlin War. You've got Chinese-US relations aren't great. We obviously got issues in the Middle East and in Russia and Ukraine. And I suppose one of the fallouts of that wouldn't be immediately obvious are that central banks aren't buying as many dollar assets from emerging market central banks. They're accumulating things like gold. Gold can be a very good diversifier, which is interesting to us as investors. So it's a building block of our AAA fund, our active asset allocation fund, which feeds the Prisma funds, which you're all aware of. So this has been a good source of diversified returns for us. And you can see that it's encouraging sometimes when there's not a lot of focus on something and it breaks higher. You can see that levels of, like Damien on my eyesight, I think it's around 2,000.
2,300?
Yeah, would have held it for a number of years, and it's now broken, dramatically through that. So yeah, it's something we're very much focused on. Look, it may be due a bit of a setback, but we think there's an interesting setup here in an asset class that's a good diversifier for.
A lot of that demand comes from India and China, doesn't it, as well?
India and China, yeah.
If you've ever been to India, and I know you have,
yeah.
Ask Philip over lunch about the time he was in a Bollywood movie, by the way. But
maybe don't.
If you've been
a great movie, Charles.
If you've been to India, though, the streets are lined with gold shops.
Bars of retail
lined
gold,
with gold shops. It's a real feature of the place.
And there's been some Chinese speculation in there. The Chinese economy has been struggling more so than Western economies. So there's a few new dynamics in it, which it's interesting, we find, to see price action when sometimes there isn't obvious reasons for it. It can suggest, look, there's something interesting going on.
Yeah, but we're playing it as well. We're overweight. We're overweighted, as I understand it.
Yeah, we've about a 5% exposure for the AAA fund to gold, which is reasonable, and then that feeds through to the Prisma funds on a risk-weighted basis.
Yeah, and while I have you, Philip, as it were, that's the wrong one. There we go. So in our publications and in our outings like this, we've been talking for quite a long time about how as long as medium-term inflation expectations stay pretty well anchored, that we're not so bothered about some of that stuff Guy showed us maybe, about the shorter terms ups and downs in inflation. This chart is 3 years from memory, yes it is. So looking at 3 years ahead in the States and where the market expects inflation to be.
Inflation is a key focus for us and all investors because central banks, most of them target inflation, so it determines where interest rate settings go. You can see inflation expectations here picked up coming out of COVID, but have settled down to not too scary levels since this is expected inflation on an ongoing basis. So Guy would have spoken about the cycle in COVID was very unusual. We global economies locked down. If you had a job when you came out of COVID, then you'd saved up money because you were working in your bedroom. You could barely leave the house in places like Ireland. So there was a big demand shock. People came out spending money initially on goods. Guy showed goods inflation. Then once travel became more obvious, spending on experience, which fed into services inflation. Then we had a supply shock out of COVID too, so it's been a very unusual cycle. And along with all of this, governments have been supporting the economy a lot. Big government support in COVID, helping businesses. But post that, we have a lot of government spending. Guys talked about infrastructure in the US, reshoring of chips, things like that. That it's kind of a different world order to what we've been used to politically. And that's had some interesting ramifications in what's happened to inflation. Ultimately, I think this is encouraging in that we don't think inflation is going to get materially out of hand, which helps support stability in asset markets. But it's inflation was just a non-story through the 90s, noughties, and 10s. It's very much back on the radar again, and something we're monitoring closely.
Okay, we're close to the end. It's been mentioned in passing there. I think it was David, might have been Guy as well. The US presidential election is coming hard at us. Damien, I'm going to look at you. For this, you being our North American expert, it's only, 6 months away? Yeah,
that's right. Yeah,
early November.
I'm sure there'll be plenty of excitement between now and then.
Exactly. So the countdown clock is on. I think the polls are pretty close as we speak. They ebb and flow, but I think they're pretty close. Isn't the reality that no matter which party wins, the market might react a little bit in the short term, but in the medium term, it just gets back to its business?
Generally, over time, yes. So there's many commonalities amongst both parties, and our job is to assess what is likely not to change, and then also what is likely to possibly change. So what we don't expect to change is this focus in the US on spending money on bringing industries back from abroad, be that the tech industries and the decoupling with China, that there's fears around that. They want to build up their own chip industry, but also industrials more generally. And that's there's common agreement on both parties on that front, and also a bit more on defence as well too. Some various factors that we're invested in are likely not to change. So then our focus is, well, what can change, and there are differences amongst the parties. So we don't take bets on the market. We don't take bets on the election because we've no insight as to who's going to win. So we need to be aware of the sensitivities. So, for example, if Trump was to win, there's likely going to be more deregulation, which may help the banking sector, for example, but where we're already invested for other reasons. So if that happens, well, that's a tailwind maybe, but it doesn't dramatically change the picture as you referenced. And then if Biden wins, perhaps there's greater focus on renewable energy. And as I mentioned, we're already invested in some utilities which help cater for some of the energy efficiency needs. So it'd be another tailwind, but it's not going to dramatically change the portfolio. So our focus is having a balanced exposure so that we're not taking a bet on the election. So as it happens, historically, the 6 months prior to an election have tended to be quite positive periods for the market, maybe because they're both competing to hand out presents to everybody, and everybody gets taken in by this. But
we'll have to hold you to that over the next 6 months.
Exactly, but at the same time, given the two candidates involved in this particular election, there's likely to be greater, uncertainty. So, for example, last week Trump was referencing, flew a kite, that he may decide to set interest rates himself, so rather than the Fed. So there's likely that's an offset.
That should work.
Yeah, there's an offset. There's likely to be lots of I guess, unwelcome news flow and things that may sound ludicrous, but in previous elections that may be taken seriously here. So there's a balance here, and I would say overall we're looking for a balance, but that it also depends on whether the president can carry Congress. So Biden at the moment is working with Republicans, and they're stopping much of what he wants to put in place. And previously, Trump had to work with Democrats to stop what he wanted to put in place. And that's the focus of the US, is try to have a bipartisan approach. So it depends. If one candidate was to win Congress, that would allow them to do more than previously expected. But I guess we're not taking bets either way. We're alert to the risks and try to understand them and see where they could be marginally better or worse.
Well, I thought the room would be interested, so that's where the question came from. We're out of time, folks, so we'll finish there. Just one last thing to say. David referenced it, obviously, that the investment team is here in Ireland. We're in that very lucky position that these guys are in Blackrock, where the rest of us are based. So all the Zurich staff are in the room. We're all in the one place. We know these guys. They're not too scary. You've met them. They're actually quite personable. They're our colleagues. They're our friends. We have full access to their thoughts and what they're up to and all the rest of it. I can't overstate how big an advantage that is for me and for people who do similar jobs out around in the marketplace, that we have such free access to these guys. So a big plus for me, and a thank you from me to you fellas as well. And I think on that note, I'll get the room to thank all three of you for your contribution over the last half hour. And I'll hand over to Rose Leonard, who's going to pick up on 2 or 3 very topical themes in the pensions market and enlighten you, I should say.
Thank you, Terence, and good afternoon, everybody. David alluded to some of the graphics on the slides there earlier, and I'm very pleased to say that I got one on dry land at least, so hopefully that's a little bit of insightfulness by our marketing team, that we're over the thin ice and the snow in the pensions world, and that we're on more stable ground and at least have some sort of a track to the future. 3 topics dominate: auto-enrolment, PRSAs and master trusts. Minister Humphreys, as you know, announced or published her auto-enrolment retirement savings bill on the 5th of April, just gone. And the proposed system is now targeted for the 1st of January 2025. So still an ambitious target, still a few hills to climb. Bear in mind the administrators haven't been appointed yet. The tender for investment managers hasn't even been issued. And a lot of IT support has to be put in place between this and then. But no change to the employees at whom the system is targeted. it's aimed at people who are over the age of 23, under the age of 60, and who are earning more than 20,000 per annum across all of their employment. So that's still the same, that's still in line with our expectations. The maximum gross earnings which can be taken into account is €80,000 per annum, although some of the employer representative organisations are looking for that to be reduced to 50,000 because small firms are under obviously a lot of pressure at the moment with the minimum wage gone up and sick pay and other things coming at them as well. Employees under the age of 23 and over the age of 60, or people who earn less than 20,000, can join on a voluntary basis if they so wish. The level of required contributions into the system is in line with our previous understanding: 1.5% employer, 1.5% employee initially, coming in over a phased basis over a decade, increasing by 1.5% every 3 years until it reaches 6% employer, 6% employee, and the government will put in a 2% top-up. So the government's way of contributing, as you know, is €1 for every 3 that the employee contributes. The nature of that means it's going to favour people on the lower tax bracket of 20%, less favourable to people on the higher tax bracket. The bill also establishes the National Automatic Enrolment Retirement Savings Authority, and that authority is going to accept responsibility for collecting the contributions and also for notifying employers who will come into the bracket of having to contribute and who won't. So the bill mentions that authority, and that's going to be set up. People who are already in an occupational pension scheme or in a private pension scheme, they can be excluded, and they can be excluded regardless of the amount of employer or employee contribution that's going in. So for instance, in a PRSA, even if the employer is contributing nothing to the PRSA, they can be excluded initially. Now, there will be a quality test within a 7-year period. That quality test, of course, could come in year 2 or year 3 or year 4 or whatever. The Minister has said it will come in within 7 years. But until that quality test comes in, there's no onus on the employer to contribute a specific amount. Okay. The employees who are existing employees of an employer and who are not in a pension scheme cannot be automatically enrolled or cannot be automatically enrolled into their employer's private scheme. Okay, so unless the employer convinces them to join, so those people are going to need a lot of advice. Employers who have existing voluntary schemes, not all of their employees may have joined initially, and if those employees haven't joined, the employer can't automatically enrol them into his private scheme. They have the right to go into the public scheme if they want. So therefore, employers have a big exercise in demonstrating to their employees which is the best system for them. More than likely, of course, his private scheme will be a better option, but he does have to point out that difference. So employers are going to need a lot of help and a lot of advice on that. Employers will also need to consider other changes that they need to make to their scheme. For instance, the eligibility rules, the contribution rates, what they're going to do about that. So employers need a lot of advice at the moment. Bear in mind there's a big difference in terms of how the investment works on the automatic enrolment system versus private arrangements that you would be used to, whether PRSAs or occupational pension schemes or master trusts or whatever. Under the AE system, there will be little choice at all on investment funds, little flexibility around the lifestyling strategy, and members, when they go into the auto-enrolment system, will merely just get the average of the 4 managers that are appointed. Even when that happens, those managers are not going to be reviewed until after 10 years. Now, that probably sounds fairly alien to all of you in the room, bearing in mind that many of you are in the space of ongoing advice to your clients. By the very nature of coming to this sort of thing, and the information which Jack and the marketing team send out to you on a monthly, weekly basis, you're very used to keeping up to date. But at the AE system, it's only after every 10 years that you have to look at the investments. So loads of opportunities, obviously, for you to get involved in this at the moment. Looking beyond the lower paid workers and looking beyond auto-enrollment, I guess the two main things that are happening in the industry are the growth in PRSAs and the growth in master trusts, okay? PRSAs, as you know, the contribution change that was made on the 1st of January 2023, and then the changing to the vesting at 75 with effect from the 1st of January 2024 has made these an incredibly popular product. Effectively, PRSAs are now a whole of life product. You can retire, a product in which you can save up to your retirement, and a product in which you can draw down after your retirement. Nonetheless, obviously, people need a lot of advice. They need to keep informed on how their funds are doing, and of course, at retirement, are they in the right funds? Do they need to be in different funds, and so on? So they still need a lot of help from you on that. Jonathan alluded earlier to the growth in the market, 19–20%. The whole regular pension contribution market has increased by almost 20% in Ireland, and of course Zurich has been the biggest provider of PRSAs. We've certainly benefited from that, and we're very pleased about that. Master trusts, as you know, we've talked about this before, they're here because of the increased regulation, been driven by increased regulation and the need to comply with that regulation. And Zurich, obviously, we're used to operating in a very highly regulated environment, and we're regulated by the CBI as a high impact company, and by the very nature of that, we're used to intense scrutiny. We're probably one of the most scrutinised companies in Ireland because of that, because of how we are regulated. And we're very comfortable in that environment. Employers are getting that too, and one difference that we've seen in the last couple of years is that more and more large employers are getting that message and are coming to Zurich to join our master trust, and coming to us to provide registered administration services to them. So that's a good thing. There are currently 17 master trusts in the Irish market. As at the end of March, the amount of money in them is about 23 billion. So I think the last time I talked to you, we were talking about a figure of about 17. That was the last figure that was published around October. So it's grown fairly substantially since that, almost a billion a month. And that'll continue. They'll continue to grow very rapidly over the next few years. Almost 500,000 employees in master trusts at the moment. Still a lot of potential for them to grow because there's probably, it probably still only represents just over a third of the people in private pension provision. So still an awful lot of companies are going to come into master trusts. So you're going to see that growth continuing over the next few years. Our master trust, I mentioned that there were 17 in the Irish market. Our master trust accounts for about 1/6 of the total assets and the total members that are in master trusts in Ireland. So bearing in mind that there are 16, that must make us one of the biggest ones in Ireland. Certainly one of the best performing ones, we know that. And I guess if there's one word that's synonymous with our master trust, one word that you should think of when you think about the Zurich Master Trust, it is the word active. And I say the word active. In Zurich, I guess our master trust, we're active about every aspect of our master trust. We're active in how we manage the risks. We're active in the whole governance framework around it, constantly reviewing it, constantly engaging with it and changing it. We're active in how we've capitalised a master trust. I think we're one of the only master trusts where the founder has put the money out separately from the founder into a separate account to ensure the long-term sustainability of the master trust. We've taken 9 million. Zurich Life has put 9 million into a separate account to ensure the long-term sustainability, and that 9 million is reviewed as it grows as well. We're active in how we engage with employers. Our team meet about 70 employers each month with one of you. And, those meetings are about making sure they understand the investments, making sure they understand the various aspects of master trusts and how it is run. And we also support employers in terms of running webinars like this, conferences like this for them too, to make sure that they're kept informed. And we do the same for employees. you understand the active nature of the investment in the Master Trust. Strong oversight by the trustees of the Master Trust. Trustees of the Master Trust meet David Warren and Ian and the team every quarter. And they provide a comprehensive report on the Master Trust. Benchmarks are looked at, performance is looked at, and market outlooks are looked at every single quarter. We look at it every year as well, and every 3 years then a very deep dive is done on the whole investment aspect. And of course our auditors are looking at it separately as well from the directors of the Master Trust. So a bit like you on pension products, a very close eye is kept internally on the performance, and the investment team have to account to the directors on that. And of course, independent of the Master Trust directors and independent of Zurich altogether, is you looking at it. You're constantly reviewing the performance of it and keeping an eye on how things are going for your employers and for your members who are in it as well. So, comparing that to auto-enrollment, I think there's a fairly big difference. You're looking at it every other day, auto-enrollment every 10 years. And we like to think we're active in supporting you as well as brokers, facilitating these sort of events. And as I said, Jack and the team sending you a lot of information. Want to facilitate you in reaching out to employers. About 12 different brokers approached us over the last year and asked us would we run round tables, mini conferences for employers that they want to reach out to. We very much welcome that. And one of the reasons why we welcome that is because Master Trusts like PRSAs, Brendan Kennedy described them, the regulator described them as the two products of the future. So they're kind of both becoming whole-of-life products. And ideally, we'd like you to be involved at a very early stage, reviewing employer pension schemes. There's, certainly another, there will be another 20, 30 billion going into Master Trusts over the next couple of years. So it's very important that you're out there early, working with employers in your area, in your vicinity that you know of, and talk to them about joining a Master Trust or about reviewing their pension scheme, because they are becoming whole-of-life products. And there is an interdepartmental group looking at drawdown from Master Trusts now in the same way as you've drawdown from PRSAs. So do get in early, and certainly we want to support you on that. And feel free. We have an awful lot of material on auto-enrollment and an awful lot of material on the market. So do talk to your broker, your Zurich broker consultant, or drop me a note if you want. If any more of you want to facilitate a workshop or a conference like that, we'd certainly be happy to support you on that and co-facilitating if you'd like. So I guess if there's one message I want to leave with you about our Master Trust is when you think of the Zurich Master Trust, just think active. We're active about every aspect of the Master Trust. My job now is to hand over to our next speaker, Ian Slattery. And Ian is going to talk you through the impact of that in active management, how that can impact on a customer and on his funds and performance. So thank you very much.
Thank you, Rose, and good afternoon, everybody. So as Rose mentioned there, I just want to bring you through how we can take some of the investment expertise that we have in the room, both from Zurich and everybody else here in terms of the financial advice market, and actually turn that into customer advice. So with that in mind, I want to start by casting your mind back to a time when someone started selling books online from their parents' spare garage using an old door as a desk. People were preparing for the World Cup in the US. EI 105 was a very particular flight of note. It was the first direct flight from Dublin to New York in over 50 years. And indeed, 30 years ago this week, Ireland retained Eurovision, but the big story actually was Riverdance as the interval show. In relation to global stock markets, the biggest three companies in the world, Shell, GE and Exxon, and indeed, if you had an Irish mortgage rate at the time, it was setting you back about 7.5%. Whilst if you were lucky enough to make it to USA 94, one Irish punt got you about 67 US cent, roughly about half its nominal value today. Looking at the makeup of the global stock market, which we would have done at the time as active investment managers, the USA, as it is today, still the biggest stock market at the time. However, look how big Japan was in 1994. Even though it hit its high in the late 80s, still 30% of the global stock market. Europe not a million miles away from where it is today in terms of its percentage of the world's stock market. And a financial advisor, you have a new client who's come in to have a chat with you. Let's assume they're 30 years of age, starting a new job, want to get the pension up and running, understand that they should have a pension, and recognise it's a good idea, but they might have other pressures at home. Many of these pressures we know at the moment. They might be trying to pay one of those 7.5% mortgage rates. And indeed, this, I'm sure, is something that you all experience on a weekly, monthly basis even today. And I'm sure if a client walked into your office or picked up the phone today, you might talk them through a chart such as this, which shows the effects of compounding and investing early and often. So showing different investors, the only, in inverted commas, and it's a big difference, is when they start investing. You assume the same amount of money into the pension, you assume the same growth rate for the period in the pension. But as you can see, and you might tell this prospective client in 1994, starting to invest monthly at 30 years of age leads to such stronger outcomes when you look through to retirement age. So the client is convinced, they agree they're going to invest monthly, they're going to index it over time. We're going to put a 1% annual management charge on it. And indeed, you're looking about companies in the market, and you've recently read the hot off the shelves Eagle Star Starscope broker publication at the time, which talks about the balance fund being funded a year, talking about the 10-year track record of the old Neta Life funds. And indeed, your client decides to invest within the balance fund at the time. And we fast forward a few years, we have the introduction of the euro. We see the big news story of the year is the impeachment of President Clinton. We see Stormont in terms of devolved government sitting for the first time in Northern Ireland. But none of this was going to matter because we're all back to the dark ages once the millennium bug hit at the end of the year. If we look at the biggest companies in the world, still household names today, Microsoft, General Electric, which indeed saw its highest ever headcount at the time, 340,000 people working in GE in 1999. And you had Cisco Systems, not quite at its record high it hit in the year 2000, but indeed that's a record high it has yet to surpass even in 2024. The dot-com craze, which was, some people would say, started with the IPO of Netscape in 1995, has led to a huge number of global internet users, 150 million across the globe, almost half in the US. And indeed, in the year 1999, you saw 12 companies listed on the NASDAQ have a return in excess of 1,000%. This dot-com boom, as it was at the time, obviously leads to a shifting geographical balance within the globe. We see the US is now half the market, Japan very much smaller, and the European market growing as a result of that. And you flash forward, your client who was 30 in 1994 has continued to invest over time, and as you're sitting down having your annual review in 1999, their pension is now worth just short of, I'm using euro, but 95,000 euro at the time. Your client starts to understand markets. They understand multi-asset investing. They've had a very good experience within the balance fund. However, they're talking about maybe they're going to start to think about retiring at age 60. And maybe, even though it is 1999 and we know what comes next, you start to discuss maybe a move into equities. And if a client wanted to talk to you today about different asset classes and long-term returns, you might borrow some of the research I'm showing you here from Barclays that have the track record going back 97 years, showing after inflation returns for the main asset classes, equities, bonds, and cash, and the clear winner being obviously equities over the long run. Your client's happy with Eagle Star, happy to stay with it, looking to have a fund switch, and indeed, you might switch them into what was then known the International Dynamic Fund, the fund we do know today as International Equity. So your client makes the fund switch, moves to 100% equities, and we fast forward a few years further. We see the collapse of Lehman Brothers. We see President Bush sign a $9 billion bailout package. We see the Summer Olympics in Beijing, and we see the senator from Illinois elected to the White House. In terms of global stock markets, we see oil companies having a very strong time of it, but also the emergence of China as a global player within listed equities. In 2008, we saw the VIX hit a record intraday high of about 89.5 in October of that year. For reference, the long-term average is 21, and it sits at about 15 today. And indeed, we saw what is still to this day a record oil price just short of $150 a barrel in late October 2008. We still continue to see an evolving geographical base or difference across global stock markets. We see the US has fallen a little bit, led by those large financials that took a hit. And if we spoke about two of the biggest three companies at the end of the year being Chinese, they obviously contribute to the yellow, which is the other, as we see. And we fast forward again with your client who's continued to invest. They've been in equities since 1999, and their value is just short of €250,000. Now, you have a good relationship with your client. They managed to stick through the dot-com bubble, but maybe two bear markets in 10 years might be a little bit much for them. However, you're sitting down with your client, you're having a discussion, and you might be bringing up something like the Eagle Star Monthly Investment Review, which many of you will actually recognize still some of the formatting we hold to this day, showing the different sectors of the stock market, different bond positions, showing the asset allocation from the fund managers, what's happening in markets, and indeed a spotlight on sectors and stocks. I suppose that's to explain what's happening in markets, how it's important to comprehend what's happening in markets. But you also might show another one of the investment principle slides that we use today, talking about different asset class returns over different timeframes. For example, if you look at the far left of the chart, the one-year rolling potential return for equities in any 1 year, as high as 61%, but as low as 43%. Bonds next to it with a narrower range, and indeed the 50-50 split somewhat in the middle. And I won't go through the chart fully, but as you move from left to right, there's two very important things to take away about long-term returns. Firstly, the range of returns narrows, and it also skews upwards. So when you're sitting talking to clients, and you're going to be talking about what's it like to be in the long run, the longer you invest, the more certainty you have in your return in terms of the narrow range, and the more certainty you have that that return is going to be positive. So indeed, your client sticks with it, no fund change here, but that's actually what's supposed to happen at that stage. You keep the premiums going, they stay invested given their age in the equity markets. And we forward another number of years. The world was captivated by a missing Malaysian airline in the Indian Ocean. We saw the annexation of Crimea for Russia. We saw a terrible Ebola pandemic or epidemic in West Africa. And indeed, we saw a contentious political referendum in the UK, this one being a no vote for Scottish independence. In relation to the biggest companies in the world, again, we see the likes of Apple, Exxon still knocking around the top, and indeed Google emerging into that area as well. In relation to commodity markets, we saw the USA become the biggest, the top producer of oil for the first time in 2014, and indeed that is a position it continues to hold to this day that has large ramifications for geopolitical activity around the globe. Interesting in Irish markets, the 10-year Irish bond yield at the time at 2.9%, pretty much bang on where it is today, albeit it's taken a round trip to negative territory in the interim decade. And indeed, just 3 years before, in 2011, that bond yield was 1,000 basis points, or close to a full 10% higher at the height of the bailout crisis, if we can call it that, in Ireland. Stock markets, as we all know now very well, the geography continues to evolve. We continue to see the re-emergence of the US, Japan nowhere near what it was in the early 90s. And indeed, your client has stayed invested over time, stuck with equities right down through the depths of the financial crisis. And now their value is just short of €500,000. Your client is now 50 and they still have that sight set on that retirement of 60. And you're discussing maybe a little bit of a de-risk, talking about a potential of a multi-asset approach. And indeed, if we were discussing multi-asset funds today with a client, you might show them a version of this chart, the patchwork quilt, if you will, showing various Zurich funds, the calendar year return going back each year for the last decade. You can clearly see the emergence of the tech run-up in the Magnificent Seven, as people have already mentioned. You can see the strong performance of Five-Star Five Americas over that time, the internally managed fund by Damien and his equity colleagues. And indeed, you see cash languishing along the bottom as well. However, we put it in the very distinctive pink. You're looking at the active asset allocation fund. Not necessarily middle of the road every year, but very much in the middle third of the range of returns on an annual basis. So your client is willing to discuss this. You decide that you will invest in the active asset allocation fund. They like that there's the broader asset class range, including alternatives and property versus the balance fund that they know. They like that it's managed by the team in Zurich, and indeed the flexible asset class ranges, an equity range that still stays intact today, 15 to 65% in the AAA fund. And you move forward another couple of years, we have the emergence of the COVID pandemic. We stopped meeting in rooms like this and started meeting on screens like this. We saw the then Taoiseach Leo Varadkar give the steps on the ambassador's residence in Washington on the 16th of March, announcing the first lockdown. And we did indeed see President Biden, as he is currently elected, back into the White House, albeit with the big job this time. And when we look at the top three companies at the time, very much those US tech firms capitalizing on the trends of the time of work from home, deliver to home, and play from home. And indeed, quite the journey for Amazon from the founder of it in 1994. Even more so when you think about that the share price, the price of Amazon went from $106 a share to $6 a share during the dot-com bubble, and indeed hit $180 a share late Tuesday night this week with a strong earnings result. In relation to oil, we saw the intraday price of oil futures fall to nearly negative $40 a barrel. And indeed, we saw the shortest bear market in history, with just 16 trading days for the market to fall 20%. It fell even further to about 35%, although what we saw throughout April and May of that year were the best 50 days ever for the US stock market. The global economy, in terms of the geographical split, we continue to see the growing dominance of the US in relation to its weighting in the global stock market. And indeed, your client has continued. You're meeting them for the first time virtually in 2020. And although it's the 1st of April I've ran this to, it's quite very much at the bottom of the return profile for that year. They're still up at about €730,000. They are continuing to approach that retirement age they have in their mind of age 60. So you decide to discuss another fund choice. You take out the Zurich Fund Guide, over 60 funds, and you start to discuss the Prisma fund range, which at this stage has been around since 2013. And indeed, we spoke about the equity range of AAA at 15 to 65%. You start to discuss the Prisma 3 fund with an equity range of 15 to 30% as an appropriate fund to move down through as they retire at age 60. I've noted the screenshot from the Prisma 3 fact sheet, the asset allocation of that particular fund at the end of March 2020 with an equity content of 27%, very much the higher end of that 15 to 30 range I just mentioned, as David and the team position for a potential COVID recovery. And we move forward, and again, we come to April 2024, and we're here today, and your client who's been now investing with you for 30 years has a pension pot of just about €1 million. And indeed, if I break this pot up look at it slightly different, what I'm showing you here in the red is the premiums put into that pension, and green is the investment growth provided by the Zurich funds. It's actually roughly a 50-50 split over time in terms of the partnership working with clients and yourselves by putting money into the pension and again, getting it to grow over time. And this is when we're talking about investment returns. And part of this is indeed compounding your money over the long run, over the time in the stock market or indeed in multi-asset funds. However, I also want to talk about outperformance over time, which is again what we're trying to bring as active managers in Zurich. Just to remind you all, these are the fund switches I rattled through when we were looking at it over time. The Balance Fund, International Equity to AAA to Prisma 3. I've taken the cumulative performance of those 4 funds for the various time periods that they're invested in. And I've also looked at the market performance. So in the case of the multi-asset funds, the appropriate market sector average. In the case of international equity, the stock market as a whole. And I have the returns of those various alternatives that you could have invested your client in at those points in time, and the returns of those funds, or indeed the market averages, and the relative outperformance. Different numbers, different asset classes, different timeframes, different length of timeframes, but consistency in terms of the cumulative outperformance shown by the funds across the 30-year period. Many of you will say, well, this might have just been a couple of good years in the early years, and again, that outperformance compounds over time. That is true. Good returns at the start of any investment journey is very, very helpful. But I think it's also important to use the word consistent. So what I've done here is, it's not just about cumulative outperformance, but we also want to look at the instances of outperformance. So we have 30 12-month periods that this case study has shown. And what I'm showing you here is for each of the 12-month periods, whether in green, the appropriate Zurich fund outperformed the alternative, or in red, the years it didn't. So indeed, for the 30 years that we've outperformed in 23 of them, or roughly 77% of the time. You will, of course, notice red on the screen, and I think we don't have a problem with that per se. Hopefully we've been able to portray today that we do have a humility as an investment manager. We're attuned to markets, we're aligned to markets, we're not predicting them, and again, we're very much self-aware. However, even in the instances where we have underperformed over these various 12-month periods, on average, it was by about 1.5%. On the other hand, if I take the periods where we outperformed on an average basis, there's certainly more instances of them, but the outperformance on average was 3% for each of those 12-month periods. So we outperform consistently, we've outperformed more, and then when we do outperform, it's by a higher amount than when we do underperform. But I think it's worth noting that this is investment returns. But when we talk about using investment expertise and turning it into advice and having a partnership with brokers, it's important to also look at investor returns. And that's what we're talking about, behavioral biases. I have some of the main ones on the screen: recency, illusion of control, loss aversion. Loss aversion is the big one we all talk about with clients. Anchoring bias, mental accounting, and there's many, many more. So the idea of bringing through some of the slides we have today is they're all available. They're available in PowerPoint. They're available to be taken away from you, by you, for your clients, and to be put in whatever format you like. And I think that's, again, something we're trying to do, is to help you provide investor returns for your client. Because whilst we can do the investment returns and provide the outperformance, at key points moving you up the risk scale in 99, keeping the premium going in 2008, appropriately de-risking as you approach retirement, are things that are done as part of the financial advice. And again, let's remember that client who is now age 60. You're having an at-retirement conversation. You might be using tools such as the drawdown calculator to make a decision between the ARF and the annuity product. You're looking at the same fund choices that they've enjoyed for over 30 years, replicating the Prisma funds, Balance, International Equity, AAA, all available on the ARF product. You might be looking at tactical drawdown to mitigate the sequencing risk effects of imputed distribution. Or indeed, you might look to rebalance the ARF back to its original fund choice on a periodic basis, a feature that we're launching into the market next week for ARFs with Zurich. So as I just come down to the end, a whistle-stop tour, a bit of nostalgia perhaps, as David said, but as we're in the 35th year of the managed funds with Zurich, it's worth noting we brought you from the Balance Fund. We took the equity expertise of that and we created a fund called International Equity as it is today. International Equity became the equity content of the AAA fund when it was launched in 2010. And indeed, AAA drives the asset allocation of the Prisma funds when it was launched in 2013. And the Prisma funds are the bedrock or the foundation of Personalised Guide Path, PGP, our default strategy on Group DC, and indeed the Master Trust. Much of what I looked at might look trivial, it might look easy or obvious in hindsight, but again, how obvious was it to keep people invested in March 2020? How obvious was it to keep invested in the financial crisis? So again, we have a very clear framework in Zurich, how we want to work. It's worked very, very well over plenty of instances of the last 30 years. We look forward to continuing to provide it, working with you and partnering with financial brokers, advisors, pension consultants, employers. But for now, from me, thank you very much for your time, and I'd like to pass over to David for some closing remarks.
Back to the outdoors. Thanks, Ian. That was fascinating. I only really looked at Ian's slides there this morning before when I was in the office, and I thought, my God, there was a lot of nostalgia, but I thought it reminded me of things I'd clearly forgotten about. But I think it was a great combination of the macro right down to the micro, the individual customer, what matters, and you say those investor returns. I've only a couple of minutes to wrap up here. So I'll probably take a little tour through everything. I started off with one set of threes, so talking about people and performance and process. I hope we got a flavor of all of those. Certainly on the people front, I thought the panel, the three lads, moderated by Terence, I think gave a good sense of what we're thinking and doing currently, including that all-important activity, taking a balanced approach, the medium term, the structural, calibrated portfolio positions in the shorter term. Advice has been referenced a good few times. Jonathan, right at the start, talked about the ongoing success of people here in the audience, physically and virtually, advisors. And the next set of three that I'm going to reference isn't new. I've used it many, many times over the years. But it starts with good advice. Jonathan referenced your success in the marketplace. Rose referenced the importance of advice. We're talking about not simple pension landscape or savings landscape, an increasingly complicated one. So the need for good advice is even greater than ever. Good products. The second part of the combination here, and Rose referenced those, whether it's PRSAs provided by people like ourselves or master trusts in the last couple of years, or going down to the multi-asset fund, our world, the Prisma funds. So good products in combination with good advice, absolutely essential. Third element, good performance. That's our bit. So myself, Philip, Michael, Damien, and all the other colleagues in the team, that's what we're about. I spoke a little bit about our process as to how we go about that. That hasn't changed. It's been the same for the last 31 years, at least, that I've been involved. I wasn't quite there for the 35-year start, but I've been there a good while. We have the same core process. I've tried to summarize it and wrap it up slightly differently maybe today, but we're still very active. That's core to what we do. We're very, very much aligned with the markets. That's the route to making long-term performance. And we're very attuned to the risks out there within the portfolios, within the markets in general. Combination of all those three elements, active, aligned, and attuned, will keep us safe and increases the chances of us delivering good performance. But then it's the combination of this trio which hopefully delivers great customer outcomes. And that's all that matters ultimately. So look, I'd like to wrap it up there. Thanks very much for everybody's physical attendance. It's great to get everybody in the room. We had to get a few extra chairs. I see some of the colleagues sitting on the steps. That's a great sign. We really appreciate you coming. The virtual audience, also really important. I hope it's all worked well, again, for everybody this year. So we'll finish up there. Look, thanks again to everybody here. Thanks to the support, continued support for Zurich. Your strength is reflected in our own strong business and so on. And we'll finish up by just having a light networking lunch, I think we're calling it. And thank you again, and wish you the very best for the rest of the year.